Hey, what's up, Green Industry? This is Dan Plata, CEO of Blue Skies Services, coming at you with a hot target budget sheet that you can use for 2021. And you guys have such a unique industry in that it's home services. You're going out to do the work, right? What I think is cool about the green industry is you have two different sources of revenue. It's not something that you sell once and you've just got this big recurring stream, and it's also not something you have to keep selling every time. You kind of have you have both of those. If you're mowing lawns at all, if you're doing fertilizer, if you have any sort of route stuff, you've got this recurring revenue that's built. But then you also have the landscaping side of things and project-based stuff where you can sell bigger one-time packages as well. So it's just such a cool way to have the best of both worlds. However, the downside of that is it makes budgeting super tough because you have these two revenue streams coming in, and how do you budget and plan for both of those, and what do the cost structures look like, all that fun stuff, which is why I went ahead and just built the target budget spreadsheet for you so that you can start with a budget that's already made. Now, I'll caveat it by saying, depending on your strategy and how much of one or the other of those types of things you do, these numbers might need to be tweaked. The cool thing is, yeah, this is already built out for you, but it's super customizable too. So you're going to see you can go so far as like literally just putting in your expected sales by revenue stream for the next year, and your budget's built. And there's your targets, and you're ready to go. But if you want to adjust those targets specific to your business, whether it's changing the percentage or even overriding it with a dollar amount, you can do that. And I'm going to show you how. And there's extra tabs for sales and marketing, for payroll, and for your assets and liabilities to actually like strategically plan each of those sections of your business and have a detailed list of what's going to happen and pull it back into the budget sheet. You can like mess with it, come up with a strategy, test it, and if you like it, there's a way to like toggle it in or out of the rest of the budget. If you put it in, it's going to adjust everything in the budget for that game plan. And then if you want to take it out, you can take it out without losing everything that was in that budget sheet. So it's super customizable, super navigable. That's good, as good as I could come up with for that word. But you'll see what I mean. So let me do a screen share and dive in. I guess before I do that, I'll say the sales and marketing, because you've got those two revenue streams, is pretty unique to you guys. Um, there's a separate video. Well, there's a separate video for how to use each of these tabs. But for you guys specifically, I made a unique video on the sales and marketing tab because you have those two different revenue streams, and you have both recurring and a repeat or a one-time revenue that you need to somehow come up with a game plan for. So go check out that video too. Go check out the payroll video and the assets and liabilities videos as well. But that sales and marketing video is super unique to you guys because you have that complexity to your business. So let's light up a screen share, and I'll take you through the main tab of how to use this thing. So here we go. Here's the badass budget spreadsheet. And I'm just going to start at the top, work my way down, kind of explain how you should put your P&L into buckets, how you should be measuring yourself, what percentages you should roughly be shooting for in the green industry. And I'm just going to kind of like hit on how this thing works while I go, so that as you're filling it out, you can have an understanding of how to read it. So the first thing I want to point out, right at the top, we've got the number of business days in each month. And we tend to act and behave like all months are created equal, when in reality, I'm looking at this, and January and February both have 20 business days, and March has 23. So we're talking about a 15% increase in revenue, all else equal, for no other reason than that month just had 3 more business days in it. And yeah, you might be working on weekends and stuff like that. So adjust those numbers at the top based on how many days you're actually out working in the field. So you have a point of reference of, I've got this many more days in this month to get stuff done, and let that soak in as you build your revenue targets. Take that into account. The next thing is your payrolls. If you're running weekly payrolls, there's going to be a few months where you have 5 payrolls instead of 4. If you run bi-weekly, there's 2 months where you have 3 instead of 2. And you have to take those into account in your budget, because otherwise you're going to look at a month where you have 5 payrolls and think you totally crap the bed, when in reality, you were running a perfect business model. You just got penalized by having that extra payroll land for timing reasons. So at Blue Skies, we run weekly payrolls for all of our service companies. So we pay 4 times a week, and then April we have 5. I said we pay 4 times a week. In general, we're paying 4 times a month, but there's those months months that have one extra payday in them. So April, July, September, and December. So we actually have that built into the spreadsheet, and you can see April and March don't have that different of revenues and just these made up numbers that I put in. But April's payroll skyrockets because it's got that extra payroll in it. So I already took that into account for you. Just always be cognizant of those 5 payroll months. So let me get into how this thing works and where we're getting this data from. So in general, anything that's gray like this, it's a formula. Don't mess with it. Just leave her alone. If it's dark blue, that's where I want you guys to type stuff in. So the first thing you're going to type in is your sales targets. And you'll see I have a line here for recurring route type of sales. So anything that is maybe like cutting, fertilizing, any like repeat service where you're coming back on a regular basis. If you're up north, like me here in Minneapolis, you're probably doing some snow plowing in the winter too. So I'd put that on a route. Anything that's like that recurring service model, build that up here because you're going to sell that a little differently. Now, you're also going to probably do some landscaping or other projects where it's one-time stuff. Yeah, you might be selling it to the same customer base, but it's definitely not a recurring model. Like you'd be lucky to do a project for them maybe once or twice every couple of years. So you've got your one-time jobs budgeted. And I think it's super useful to break those two things apart because it's almost like two different businesses. Yeah, you might be able to use the same labor for doing both of them, but two very different streams of income and two types of clients. So that all rolls up and it totals up here into this gray line. Like I said, don't mess with the gray. So here we go. Here's our sales target. We're expecting to do $500,000 in sales this year. That's what we've got. So now, once you're actually going through the year and you're getting actual results, you're going to want to start putting actuals into this budget to see how you're doing against your budget, right? The first would be the sales actuals. And you can see I've got 2 different lines in here for sales. And you might be like, well, yeah, Dan, you've got 2 different lines for sales because you budgeted them in 2 different ways. And that's not actually what this is. There's 2 different types of sales. There's cash accounting sales and there's accrual accounting sales. And it's really accounting for the same money, but it's the timing of when those things go. Cash accounting is for tax related purposes, and it's based on when the money gets deposited into your account. Accrual accounting is based on invoices, and we use that. It's based on when you invoice the client, not when you collect the money from that invoice. And we use that to assess how well we operated. So one is for making sure you're paying the right amount of taxes. The other is for making sure you're operating your business efficiently. Yeah, you're counting the same money twice, but the timing of when it lands can be very different. Especially if you're doing commercial stuff, right? They might want to pay 30, 45, 60 days even. And so you're going to have an invoice and you're going to have a lot of expenses tied to that invoice that you're going to have to pay now well before you collect that money in the future. And we're going to assess our operations based on when we invoice that money, not when we collect it. We still want to collect it, obviously, but that's like a totally separate business problem. So in this case, go put in your actual cash sales, how much you deposited in the bank in sales, and your invoiced accrual sales here. So cash sales, you generally get from QuickBooks, whatever accounting software you've got, how much you deposited that month, and then your accrual sales will be from your CRM, how much you invoice that month. All right, now let's talk about those tasty expenses. So we're going to break our P&L down into 5 buckets. And it's 5 buckets for very intentional reasons. There's 5 different types of business decisions you make. There's not 3, there's not 6, there's 5. And each one of those is strategically different and like literally is a different skill set of your decision-making skills. And so if you're measuring it any other way, you're leaving decisions on the table, or you're like grouping stuff in the wrong way that you're not allowing yourself to make good decisions. And what I typically see when I'm talking to other people in the home service industry or bookkeeping clients of ours is that they're like, I'm bringing in a lot of revenue and I know I'm efficient, but I have no money left and I don't know where it's going. And it's because they're not breaking stuff down into the right levels of detail to make good decisions. It just looks like there's expenses and it looks like there's revenue, but there's not a strategy to it. So this is very intentional, very strategic, and took a decade to get this built out right. First is cost of goods sold. That's the first bucket of expenses. It's all the stuff that happens in the field every time we go out to do a job. It's the stuff we're using in the field to complete the task. So cost of goods sold is going to be the wages, obviously, for the people that are out doing the work. And you don't need to split up their wage from their payroll taxes. just group that all together. You can see that's what we did in the budget here. You're going to have some uniforms and apparel for that person, maybe some safety gear for that person, whatever they're wearing out in the field doing the job. We got a 0.5% built in for that. You got your workers' comp, you got damages and repairs because something's going to happen, right? We're going to break a customer's something or other. It's probably not going to happen like evenly throughout any month. Just one month, you're going to be like, oh man, that's expensive. But it's not quite so expensive that I'm going to file an insurance claim. So damages and repairs. You got your fuel, both to get out to the job and to run your equipment. Merchant fees, which part of doing a job is getting paid for it. I don't know about you, but like we have our window cleaning business in Minneapolis here, and when we go clean windows, I do expect to get paid for doing so. And I'm either paying a guy to go run around with that check and go deposit it, or I'm paying a credit card processing. So either of those are going to fall in the cogs here. Getting paid is important. And then we've got supplies and chemicals and tools and equipment. And I want you to think about how you operate your business. How much of your work is recurring? Are you very heavy in the mowing and fertilizing end of things, or are you very heavy in the landscaping end of things? How you divvy up your business model is going to dictate what these metrics should be. And this is like assuming you're doing a good, decent amount of both. If you're really heavy in one of those, you probably have less supplies and chemicals if you're doing mowing and fertilizing more. And you have more supplies and chemicals if you're doing landscaping stuff. And right, you're like getting sod and getting stones and getting bricks and this and that. And so you've got like supplies that are getting left at the job site. So when we're talking supplies and chemicals, we're talking about stuff that doesn't go from one job to the next, but generally is disposable or is part of that job. It's staying at that job site. The next line would be tools and equipment. That would be your mowers that don't get capitalized. So anything under 2,500, that's equipment that's being used out in the field, just not big enough to capitalize on the balance sheet. Might be a small trailer you got, or weed whackers or something like that. And that sort of stuff is going to go in tools and equipment, and it generally gets used over and over and over and over again. So that's why we separate supplies and chemicals from tools and equipment. Now, if you're doing more mowing, fertilizing stuff, you might actually have more tools and equipment that are not on the balance sheet than if you're doing more landscaping. So again, how you divvy up those two types of services, those two revenue streams, will dictate your numbers here. So feel free to override those. That's why I built the percent override column and the dollar override column. So let me show you how that might work. You might be like, Dan, I do a ton of landscaping. I know I'm more like 12% there. So you put in a 12 and just bloop, done. It updates everything to 12% of revenue here. Now, you might also change your sales numbers up there if you were really doing that, but I'm not going to do that in this example because I'm just trying to show you how this works. And you may be like, I don't, I'm 2% tools and equipment. Another way you might use it is you're like, workers' comp. Yeah, I'm going to pay, this 10,000 for the year that's showing up over there, but I'm going to pay it evenly across all the months. I'm not going to pay 300 in the winter and 1,400 in the summer. Like I pay the same workers' comp bill every month. And I know that it's $900. So you type a 900 in the dollar override column and it just, spreads it evenly then across all the months. And if you said, you put a percentage in here to override it, but then you went back and said, oh no, I think I'm actually going to spend like 5,000 a month on it. That will override the percentage. So you can see now everything is 5,000 in there. So that is how those override columns work. Basically, they kind of work from like right to left. Dollar override is going to override percentage override, which is going to override the industry target. Now, I've got these tabs at the bottom here that I said I'm not going to talk a whole lot about on this video because they're separate videos to go through them. But sales and marketing, if you fill that out and you hit the use button, it's going to pull those sales right into here and override these. And it's going to pull the marketing info that you entered in and override the marketing section down below. So that override kind of overrides these overrides. Get it? All right. So when you fill this out now and you put your actual expenses in during the month here, right in the section below where the budget is, it's going to do something kind of cool. To the right of the section, it's going to calculate the percentage of the accrual-based revenue. So how much of your wages, what percent of that was it of your accrual-based revenue? And again, accrual-based revenue is the revenue that you invoiced, not what you deposited but we want to use how much you invoice to assess your performance from an operating standpoint. So we're looking at percentage basis, accrual-based revenue, and it's going to calculate that for you. And it's going to tell you total cost of goods sold percentage, and it's going to show you how you performed against your budget. So the second column here will be the variance of your actuals versus your budget. And as you fill it out, it's going to color code it. So if you beat your budget, it's going to be green. And if you miss your budget, it's going to be yellow for each individual line item in here. And this top line item, it's gonna go stoplight even. So if you beat it, it's going to be green. If you miss by 2.5% or less, it's going to be yellow. And if you miss by more than 2.5%, it's going to be red. So it kind of is like red is, hey man, you're way out of line. Yellow is you're real close to the budget. Green is you beat it. So I'm not going to mess with that here because then I'd have to like make up a whole bunch of numbers and that'll take longer than you want it to take. So just know that as you go, that's going to be working and filling itself out and color coding right along for you. So in general, in the lawn care industry, you can see there's some goofy timing things going on because we've got some seasonality in there, but we would expect our cost of goods sold to be around 55%. That's the cost of everything happening out in the field, from the labor to the supplies, tools, equipment, fuel, all that stuff, which means we get to keep about 45% of every dollar we make out in the field. Now, we're business owners. We know we're not done spending money yet. We don't get to keep 45%. We know that. So again, there's four more spots that we spend money on, four more buckets that we spend money on. And it's super important that you measure each one of these buckets and know what's going on in these buckets, because each one is a totally different strategic decision you make. So the first is marketing. How do you acquire leads and turn them into clients, right? So we have advertising and marketing. We have 5% set aside for that. And I want to talk about some areas where you'd spend that money. And again, how to think about breaking this down so you can actually tell how you're doing. So first would be charitable donations. If you're giving money to any charity, it's still a business expense. People often are like, oh, it's giving to charity, it's tax deductible. Anything you spend in a business is tax deductible. So yeah, it's tax deductible, just like, buying gas is tax deductible. Anyway, I think that's always funny. But if you give money to charity, like, it's supporting your brand, even if you don't expect to get clients from it. Maybe it's not part of your client acquisition cost, but it's still building your brand. It's who you are. Client gifts. If you got some big strategic accounts and you're buying them holiday presents, whatever, because it's December 18th when I'm filming this, client gifts would go in here. Put a little budget in for that. I've got 0% in for now. Here's the big three. You've got your marketing software and website, which is your marketing infrastructure. It's not generally like converting clients or bringing a bunch of clients in, but it is making it look pretty when they come to buy, right? So your website cost. Maybe not the fee to build a website. I would put that down here in marketing labor, but just like the cost of keeping it up to date. I'd also put software in there like Responsibid or something that's or LawnBot, where it's like a bidding software so that it makes it easier for customers to buy from you without having to talk to you. Simple Growth has some awesome bot tools as well, so you can interact with your clients easier, get them to buy. But it's just making the lead that finds you, it's making you look sexier, right? So now we got the things that we're going to spend money on that we expect to acquire clients. We've got ad spend and awareness. So that'd be like your Google ads, your Facebook ads, your home advisors, anywhere you're spending money to go get that next client. And then you've got your marketing labor or contractors, where you're maybe paying for somebody that has expertise in Google ads or Facebook ads or whatever the case is. You're paying them a fee to go do their thing. So you're going to allocate some money to that as well. So we've got 5% in here. I'd say 5% is not a super aggressive number. It's a keep the lights on, keep status quo, rely on referrals and repeats to slowly grow the business. You can definitely get more aggressive than 5%. Just always keep in mind, when you do, you're kind of taking it out of your own pocket to hopefully have more in your own pocket in the future. Totally cool. That's actually kind of the fun part, right? So next bucket, again, super important to have these buckets. The admin bucket is the set of expenses that you pay to convert those leads into clients and to try to keep them happy. It's mostly labor. It's mostly an office person, a salesperson. It's probably you you should be an S corp. You should be paying yourself a salary. You should be in this bucket. Now, if you're out in the field, you should still pay yourself a wage. Don't just distribute money to yourself. Treat yourself as a normal business. Pay yourself a wage. Run yourself through payroll. If you're on the field, though, put your wage in the cost of goods sold. If you're in the office or doing sales, put your wage in admin. 12% is a good level. You can definitely beat it, but 12% is a good level to have a threshold. I wouldn't go above that for admin wages. You've got some fees in here for running payroll. You've got some fees for having a badass bookkeeper to help do all this stuff for you. I hope you don't have legal fees, but I gave you a little bit of wiggle room in case you need them. Same with business consulting. And I want to clarify, business consulting to me is not having a coach or somebody like talk through stuff like I'm doing right now to you. Business consulting would be like paying somebody to do something for you. So like if you hired me to build you a spreadsheet like this, maybe that would be business consulting. But if you're just paying a coach to like teach you strategies and frameworks, that wouldn't go here. That'll go down below. I'll tell you where that goes. But this would be like somebody actually doing something for you for your business, hands-on stuff. A little bit for bank charges, 1% for office supplies and expenses, the computers, the pens, the paper, whatever. You can beat 1%, by the way. That's some wiggle room in there. And then because I needed to get this to hit 15%, there's 0.2% for other general admin expenses, which is basically like stuff that didn't fit anywhere else. So 15% on admin. Now there's 2 more buckets of overhead. And these are things that generally don't get you a return in your business. No customer is going to pay you for these things. They might pay you to have a great customer service person. They might pay you because you make it easy for them to find you. And they're obviously going to pay you to have decent equipment and labor that's going to come do a good job for them. These other expenses here are generally ones that they don't think about paying you for, which is why it's hard to justify spending a lot of money on these things. And is why it's so important to manage them specifically in these buckets and be thoughtful about it because they can get out of hand pretty quick. The first is fixed expenses. Fixed overhead expenses are ones that you proactively think about, set up, contract, and usually you're like locked in for a period of time. Or it's just such a pain in the butt to switch that you're going to just live with it for a while after you sign up for it. It's typically something you're paying monthly, some sort of bill, and it's fixed in that when your revenue goes up or your revenue goes down, you're still going to be paying the same bill. So these are really sticky costs. There's things like liability and auto insurance for all your equipment and your vehicles and all that stuff. Rent, right? You sign a rent agreement, you're going to be in that rent agreement for a bit. Hard to get out of. Software expenses, whatever you're paying for your CRM. And notice software is in here twice. It's also in marketing. If there's software specific for client acquisition, that's going in marketing. If it's operational software like a CRM, QuickBooks or something like that, it's going down in here. And then utilities, phone bills, internet, that sort of thing. Just again, more bills. This is an area where you're probably for sure going to want to use the dollar override because my guess is your liability insurance isn't $300 in winter and $1,400 in the summer. It's probably just $1,000, whatever it is. So probably going to want to override most of these with dollar amounts that are specific to what you know is going to happen in your business. But at least in general, you know what you should be shooting for, 5% in total. The last bucket before I totally run out of breath because I'm talking so fast to try to keep this exciting. Accounting, exciting. The two just go together, right? All right. Variable expenses. So whereas fixed expenses are proactive, thought out, you make a decision, you contract, you negotiate, and you live with it. Variable expenses are the total opposite. It's like, oh, I knew that was going to happen. I just didn't know when it was going to happen, and that's how much it's going to cost. Okay. Yeah, I guess we'll throw money at that to make the problem go away or to pursue the opportunity. So it's reactive instead of proactive. And this is a great measure. Like, yep, we all know that person that's just not frugal at all. Their variable expenses are really high. We also all know that person that's super frugal. Their variable expenses are super low. They just find a way to like get stuff done and spend nothing on doing it somehow, right? So the stuff that goes in here, auto expenses that are like tags, licenses, fines, penalties, just kind of like random other auto stuff. Education and events. So this would be if you're like paying for a coach. If it's like one-time coaching, I'd put it in here. If it's a long-term like monthly fee that you pay a coach, I'd put it in dues and subscriptions again, because this would be like a fixed expense. You're locked in. If it's every once in a while and you can get out of it easy, then it's probably education, events, leadership development. If you're going to a convention or a conference or whatever, that would be an education, events, leadership development. You got meals and entertainment. Most of your meals are probably personal, but a little bit of wiggle room to have lunch with somebody on the team. And I differentiate that from employee engagement, because if you're doing stuff for the entire team, you put it in employee engagement and it's fully tax deductible. Meals and entertainment is not fully tax deductible. It's like 50%. So that's what's going on there. Recruiting, carve some money up for that for sure. Like, we're a service company. Literally, all we really have going for us is the people that we're sending out to do the work, right? They are the product at the end of the day. And if they're not good and they're not doing a good job, we don't have much as a business. So make sure you got A players on your team. Make sure you got the best team possible. Invest in recruiting, right? Repairs and maintenance for your vehicles, repairs and maintenance for your tools. A little bit for shop supplies, although I don't find like most of your supplies are probably going out in the field on the truck. If they're on the truck, it's tools and equipment. So maybe you got some wrenches and screwdrivers and stuff at the shop. Other taxes, licenses, penalties, permits, there's not a lot that's going to go in that. Your taxes do not go here. If they're income taxes, they're personal, which would be a distribution if you pay them out of the business. Sales taxes would just be a reduction of your sales at the top. Every once in a while, though, you'll have like a local tax payment or a local business license or something. That's what's going in here. And then a little bit for travel and a little bit for travel meals. And again, travel meals are different than meals and entertainment. Travel meals are fully tax deductible. Meals and entertainment are not. So keep them separate. And that's it. So now we get down and we're about 15% operating profit in the green industry. That's generally what we're shooting for. Now, this isn't including depreciation on your assets. So when you buy a truck, when you buy a trailer, when you buy a new mower, whatever it is, that is going to be on your balance sheet. That's going to get depreciated for tax purposes, but you're not going to see that expense throughout the year. It's just going to happen at the end of the year, done by your CPA. So there's this section down here to capture it. If you feel like diving in further, you can do a little bit on your taxes, which would be enter your depreciation in here. Or if you nerd out on the assets and liabilities tab and actually put your equipment and the specific depreciation and the loans you have over here, you can pull that in. It'll pull in here at the end and capture that. Or if you just said like, well, I know my depreciation is going to be 50,000, you can punch it in and it'll reduce your income in December to capture it. And then you put your actual in here, of course, in the blue space. So that's how you get your taxable income for tax purposes. Now, the other thing that I hear in bookkeeping all the time is, hey, Dan, like I know I'm making a lot of money. My P&L says I'm making a lot of money, but then I look at my bank account and there's no money left in it. Like, what's going on? How can I be making so much money and have no money? And the answer is because you're taking it or somebody that you borrowed money from is taking it. So go and get your distributions or project your distributions separate from payroll, right? If you're running payroll, it's on your P&L, it's going out of your business as a business expense. If you're just transferring money from the business account to your personal account, it is not a business expense. It's a distribution, just equity out of the business, like a business paying a dividend on a stock. So that's coming out as an owner's distribution. That goes down here as just cash flow out of the business, but it's not going to be on your P&L. It's going to come out of your balance sheet. Inverse of that would be if you put money back in, you don't have to pay taxes on putting money back into the business. It would be an investment. It'd be an owner's contribution. The other cash outflows that you might have is when you finance equipment, vehicles, whatever, and you start paying those loans back. Most of that loan payment is principal, and principal is not an expense. You're just paying a loan back. The only thing that's an expense on those payments is the interest portion, but most of that loan payment, again, is going to principal. And so it's a big cash outflow, but it's not on your P&L. It's just paying a loan back, which is on your balance sheet. So those cash flows are super important to capture so that you can understand the difference between what your profit says and what your bank account says, because it's frustrating when those two things aren't the same thing. And that's oftentimes the case. So all that said, that's how this main tab works, you guys. Quick sneak peek, go check out the sales and marketing video. But if you want to mess with this, there's a spot to put in marketing for recurring revenue. There's a spot to put in marketing for one-time revenue. And if you pull this all in, you can see I like already kind of filled it out, and I'll get way more into detail on the sales and marketing video for this. That if you got this from our website is probably down below. I don't know why I did that, because you wouldn't be looking at that screen anymore anyway. That's what cool YouTubers do. So that was what I did. All right. So if you wanted to use this, don't worry about what's in here yet, but you literally just click use, and then we just go back here. And now all of our, well, don't want to mess with gray. Don't mess with the gray cells. So all of our sales numbers in here change. You can see these are no longer the total of what's in the cells above. It is the total of these. So it's this 563,000. It just magically came in here. Now the cool thing is all these percentages apply to this row. So all these numbers adjusted. The other cool thing is sales and marketing is tied to that tab. And so now this says we're going to spend 8.6% in marketing this year instead of 5% based on our sales and marketing plan. We're getting aggressive. And so if we go down, we're probably going to have less income than the 15%. Yeah, we have 11% profitability this year because we're doubling down on marketing. We're building our client base so we can grow more into the future. That's pretty cool. That's worthwhile. So anyway, now we might have like built this out and we're like, yeah, no, that doesn't look good. And I don't want to use it, right? I'm going to futz with this more. So I didn't lose anything here. Like I just took use out of here. Just hit delete and it's gone. And now if I go back here, we're back to the 15%. So I didn't lose anything. It just readjusted back to what it was. The payroll tab works very similarly. You can go through how you pay employees, how you pay trainees. Do you pay people hourly? Do you pay them commission? How do you pay your office staff? How do you pay your salespeople? So it'll build up your admin payroll. It'll build up your cost of goods sold payroll, and it'll pull that in. And then lastly would be the assets and liabilities. There's a spot to add new equipment and vehicle purchases. There's a spot to bring in existing loans and non-asset related loans, like if you have an SBA loan or something like that, and break apart that interest and principal, and a spot to put your depreciation. And then you can pull that in with this little fancy drop down. All right, that's it. I'm going to stop sharing this thing. Thanks for checking that out, guys. If you watch this and you haven't got your target budget sheet, go to yourblueskies.com and grab that target budget sheet. This is the lawn care and landscaping one. Obviously, there's a whole bunch of them out there, so make sure you get the right one. But also, I'd be remiss if I didn't say, if you're like looking through this and you're like, hey, Dan, that's all cool, fine, and dandy, and I appreciate you filling that out, but I hate this stuff because I run my business. I'm not an accountant. Then hit me up, you guys. This is literally what we do for the home service industry. We do bookkeeping, we do budgeting, we do P&L analysis to help you make better business decisions, which I think I'm just out of breath. Help you make better business decisions, which helps you make more money. So this is what we're all about. Go get your target budget spreadsheet. Go watch the other videos on the sales and marketing tab, and the payroll tab, and the assets and liabilities tab, so you can really nerd out and like build a badass budget, or just take the one I just built for you. All right, that's it, guys. Merry Christmas, happy holidays, all of those things, and thanks for downloading the Target Budget.